Hi guys, this is Mr. Ibrahim the trader of Gova Trading Academy. So in today's video, I'm going to be showing you guys what we call the psychological level and also what we call the D1 candle location. Okay. Now, some of you might not know this and you might know it and then you might not be paying much attention to it. We have two types because I have done the video already for what we call the psychological level. The video is there. If you go back to the previous modules, you might see a video that says psychological level, discussing about location. Now, you might not know that we have two types of location. The first type of location we have is we have the psychological location level, which is number one. Number two, we have the D1 candle location. So these are the two types of location that we have. These are the two types of location that we have. So now, let us discuss about the D1 location, the D1 type of location. On the D1 time frame, I told you guys that if this is a bearish candlestick, for example, right now, this is a bearish candle. This is a bearish candle. On this bearish candlestick, I told you guys that the supply of the candle is from the open all the way around here. This is the supply of the candle. So this is a location on its own. This is a location on its own. It means that your proximal line or distal line, that your proximal line and distal line zone has to be sitting on this location. It has to be sitting anywhere around this location here. So this is the candle location. This is the candle location. The same thing applies for a bullish candlestick. This is also a bearish candle. So if you have a sell trade, your sell trade should be sitting on the supply side of the candle, which is the location, which is a good location for the candle. That is the good location for the D1 candle. That's the D1 candle. Now, let us analyze this AUD-USD. The first thing we do in professional course is to mark out the monthly equilibrium line, which is a blue line. The next thing we do, we switch to H3 time frame to mark out our weekly equilibrium line. Now, I showed you guys a trick to be able to mark out your weekly equilibrium line in a more easy way. Remember, I told you guys to always mark out your weekly equilibrium line, which is your green line. Always mark it out at the back of your mind. Always mark it out at the back of your mind. Now, you can use the current market price to see where your weekly equilibrium line is supposed to be. Now, as at the time of the analysis, the equilibrium line, the current market price was around here as at the time of the analysis. But let us still assume that the current market price is currently here right now. So if the current market price is here, as at the time you are doing this analysis for what is going to happen in the market next week, you can see today is Thursday. So we are trying to analyze what is going to happen in the market next week, Monday or Tuesday or Wednesday. So this is the best time to start analyzing the market of what is going to happen next week. Now, we have the blue line below. And I told you guys that you should always use your current market price as your green line. So this is the current market price right now. You can see it is moving. It is currently moving. So automatically at the back of your mind, you should make this current market price turn it into a green line. Assume that it is a green line. So if it is a green line, it means that the blue line is down, the green line is up, which means we have what? Which means we have a buy alignment. We have a buy alignment. Now, in a buy alignment, what are we looking for? We switch back to the D1 time frame. Immediately after you determine what alignment it is on the lower time frame, you switch back to a higher time frame, which is the D1 time frame. Now, on the D1 time frame, in a buy alignment, we are focusing on a bullish candlestick in a buy alignment. Now, as at the time of the analysis, let's say, for example, some of you guys are seeing the trade for AUD/USD last week, which is last week. Some of you guys are seeing the zone here last week. Let's say the candle here has not happened yet. So right now, I'm trying to also show you some of your mistake of what you did last week. Last week, you guys are taking this zone here. You guys are taking the candle here. It is a good analysis. You guys are doing good analysis, but there's one last mistake you guys made, which is you failed to acknowledge a higher time frame demand level. You cannot just be picking any house zone at any place you like. You have to consider where the zone is sitting on a higher time frame level. Now, you can see here last week, you guys are marking out this demand level on AUD/USD, which is very, very wrong. It is very wrong. Now, why is this wrong? Why is this wrong? It is wrong because it is not sitting in a demand area. It is not sitting in a demand area. Now, for example, does it make sense? Let's say, for example, guys, logically, let us assume that market has been giving us this type of formation logically before. Hold on. Market has been giving us something like this. Market has been giving us something like this. Now, market is currently coming down. Market is coming down. Market price is around here. So right now, what we have is market is going up, market is coming down, market is going up, market is coming down. And you guys are buying around here. It means you guys are buying in the middle around here. Does it make sense to be buying around here? Or it makes sense to wait for price to come all the way below before you buy? It makes sense for you to wait for price to come all the way down below for you to buy, because that is the psychological demand level. That is the psychological demand level. And this is what I mean by psychological demand level. Look at it. Right now, this candle here, it is not sitting in a demand area. It is not sitting in a proper demand area. But look at this bullish candle. Look at this bullish candle that we have here. This bullish candle that we have here is sitting exactly on a psychological demand level. Let me remove the monthly equilibrium line for now. Temporarily, let me remove the monthly equilibrium line, okay? So you can see that we have this bullish candlestick here, and this is the demand of this bullish candlestick. Now, which bullish candlestick do you think is more stronger? And which bullish candlestick do you think is sitting on the demand, psychological higher time frame demand level? Now, what we mean by psychological demand level is areas whereby market has been rejecting the area in the past. Whenever market price come into the area, market usually rejects the area. Whenever market price come into the area, market price usually rejects the area. When market price came here, which psychological level do we have telling us that market has been rejecting this area? Zero. There's nothing here telling us that market has been rejecting this area for a buy. So you can see here also, it is very wrong for you to be buying here, since looking left, there's nothing telling us that market has been rejecting and buyers are buying around the area when price gets to this area. No. But do you notice that whenever market price come into this area here below, which is far below here, whenever market price come into this area, market price rejected here when market came here. Market price rejected here when market came here. Market price rejected here and went up when market came here. Market price rejected here and went up when market came into that area. Market price rejected here and went up when market price came into the area. Don't you think that if market price come into that same area again, market has a higher chance of going up in the area? Yes, market price has a more powerful chance of going up in the area because previously this area has been a psychological demand level for the market. It has been a psychological demand level for the market. So you can see that it makes sense for you to be buying in areas whereby market has been serving as a psychological rejection level. For example, look at these selling positions that we have here. Look at these selling areas that we have. Whenever markets come into these areas, do you notice how market is rejecting and selling around the area here? Market has been rejecting and selling off around here. Market has been rejecting and selling off around here. Do you think it is a coincidence that we have a bearish candlestick here? The supply of the bearish candlestick was rejected, and then markets dropped down immediately from that area. Do you think it is a mere coincidence? It is not a coincidence. That is because that is the market behavior. That is the market behavior. Now, you also need to understand that the psychological level does not usually play all the time. However, it usually play at least 80% of the time. It has a more higher chance of playing out. But you can see this one, this candle here, it has a very low chance of playing out because market has not shown its psychological side. Market hasn't shown us that whenever price come here, it is rejecting. Now, the only time I can be buying around that level, the only time I can be buying around that level is if I see something like this in the market. For example, let's say, for example, this area has not happened yet. Now, the only time I can buy around this level here, the only time I can be buying around this level here is only if I see that market has been rejecting the level in the past. That is, market has been rejecting the level in the past. Market has been rejecting the level in the past. So if market is coming back down, I'm going to be taking this area now. If market, hold on, let me redo it again. It means that market has been rejecting this level in the past. It means that there's a drop-based rally here. There's a drop-based rally formation here. Now, there's a more higher chance that if market price is coming back down into this area, right now, this is where current price is right now. Current market price is currently here. So I mark out this demand level here because I can see that previously, whenever market price come into the area, market price usually rejects the area. It has been rejecting the area in the past. That is what we call psychological level. So we have a more higher chance that if markets come into this area again, market is going to reject and go back up again. It is as simple as ABC. Okay? It is as simple as that. You just need to, whenever you have a zone, you guys are doing a very good analysis, by the way. You guys are doing a very good analysis. But this is just the only mistake you guys are making. The only mistake you guys are making. You guys are not considering the higher time frame psychological level of the market, which is very important. It is very, very important. So you can see here, market is not going to play out, and that is why market was hitting your stop loss around here, because there was no evidence of previous psychological level for buying around here. There is nothing to show that buyers are the ones in control around this level. So that is why market price just went into its down. So you can see this area now, it has a more higher chance of playing out than the one we have above. Because we have a psychological level telling us that on the previous notes, market has been rejecting this area previously. Market has been rejecting that area previously. Whenever markets come into that type of area, market has been rejecting it. So this is what we mean by psychological level. Okay. And it is not that this psychological level is going to keep playing out. No. But what it means is that it is going to make your trade more beautiful in terms of not hitting too much stop loss in your trades. Because if you don't recognize such psychological levels, you are going to be hitting stop loss unnecessarily without knowing the reason why, even after you are able to take a good demand candlestick and you follow all the rules and regulation, but just because you didn't follow this last rule, it means that your trade might not work out. It might play out and it might not play out. So my advice to you guys is, whenever you're analyzing the market and you see that your zone is not sitting on a psychological level, then you should not take the chance of trading it. You should not take the chance of trading it. You understand? So that is just my point of view here. Okay. Now let me see if I can show you more examples. But with this explanation I made, I believe you guys understand what psychological level is by now. You can see here, we have psychological level. For example, let's say, for example, this area has not happened yet as at the time of the analysis. Let us assume that this area has not happened yet as at the time of the analysis, even though it has already happened. Just for explanation's sake, it has not happened. Now, if you see that it has not happened, you see that market, you've already marked out you've marked out your supply level on this candle here. You've marked out your supply, your supply level. And the zone, your yellow zone is sitting in a very good location on the D1 candle. It is sitting in a very good location. Now, what you also need to understand and consider is this area a psychological level previously? You have to consider. You can see here, market rejected here when price came into this level. Market rejected here when price came into the level. Yes, so yes, it is a psychological level for sellers. That level is a psychological level for sellers. That is why when price came into that area, market price rejected and went down and went down. It is as simple as that. It is as simple as that. Now, look at it. Market came there and rejected and went down. Very, very simple. Very simple. You see, market came to the level, rejected, and went down. Very simple stuff. So you guys need to understand the psychological level, the lesson for psychological level is very, very simple. You just need to know how to open your eyes on identifying what a psychological level is. And I can see that Mamun has been doing a very good job in identifying what a psychological level is. Very good job. Now, look at this example also here. On this example, do you notice that market price came into this demand candle here? Let's say, for example, you mark out your zone here on this bullish candle. I'm talking about this bullish candle now. This is just a rough example, right? Now, on that bullish candle, do you notice that market came exactly into that candle and then went up? Why? Why did market price went up? That is because previously, when markets came into that area, market has been rejecting the area for buyers. Market has been rejecting the area. So you can see markets came there, rejected, markets came there, rejected, markets came there, rejected, markets came there, rejected, market came here, rejected. So if market happens to come back again, it has to reject. It has to reject. Okay. So just make sure you are trading in a psychological level area. You see here also, we have what we call the sell. Look at this sell trade, this massive selling here that market went down to be selling here. What happened? Why is market selling around here? If you look previously, because I believe you guys know that this is your location candle. This is your location candle on the D1. After marking your location candle on the D1, you expected market price to come back into your zone. All right, market came back into your zone now. Market came back into your zone. What guarantee do you have that market price is going to go down? Now, the guarantee you should have that market is going to go down is the psychological level. Because look at it. Market, when market came into this area, market has been rejecting this area and selling. Market has been selling and rejecting this area. That is why when market came back into that area again, that area was a psychological level, and then market came back again and respected the psychology. So market usually respects the previous psychology of what happened in the past. Market usually respects what happened in the past. So you guys need to know how to take advantage of this information. Remember, I'm not telling you guys that every time it is going to work out. No. What I'm telling you guys is that it increases your chance of winning than before. It increases your chance of winning than before. Okay? So try to learn what psychological level is and take advantage of it. Okay, you see here also we have a selling zone here. You happen to mark out your candle. You happen to mark out the supply of the candle here. After marking out the supply of the candle, do you notice that market price went down to sell? You see how market price went down to sell here. Why did market price went down to sell? Because this area is a psychological level. When price came here, market rejected and sell. When price came into this area, market was rejecting and selling. So there's a psychological selling level around that area. There's a psychological selling level around here. That is why market came there and sold again. Market came back there and sold again. Why did market price buy around here? Why did market price came here and went up? Market went up in the area because when you look left, you should see that market came here, rejected, and went up. Market came here, rejected, and went up. Market came here, rejected, and went up. It is a psychological level for buying. Market has been coming there and going back straight up. Market has been coming into that level, going back straight up. So you see, you need to know how to understand psychological level, okay? You see what I mean is here. Let me turn it into a line, You see, market has been coming into the area, rejected, went up, rejected, went up, rejected, went up. So it is a psychological level. It is a psychological level for buying. That's why when market came into that psychological level again, it rejected and did what? It rejected again and went up. It is a psychological level. It is a psychological level. So you guys need to understand how to use psychological level. Now, I'm not saying that you guys should start switching to a line chart. No, I'm not telling you guys to switch to a line chart. No, stick to your candlestick. Stick to your candlestick charts. All right. So that is it, guys. Now look at it here. You see here, this is a psychological demand level. Market rejected here. Market rejected here. Now we have this candle. We have this candle here. If you happen to mark out the demand of the candle, let's say, for example, you have a trade there. And let's say, for example, this trade has not played out yet. Let's say, for example, market has not happened here around here as at the time of the analysis. It means that as at the time of the analysis, this is what you have. You happen to mark out the demand level of this candle. You happen to mark out the demand level of this candle. After marking out the demand level of this candle, what are you waiting for? You are waiting for market price to come into your zone and then go up. That is what you are expecting. Now, what is going to give you the peace of mind that market has 80% chance of playing out is that market has been rejecting the area in the past. Whenever markets come into the area, market rejected and went up. So definitely, if markets come into this buying candle area, expect market to reject the area also and go up. That is what psychological level is all about. It is not complicated at all. It is not complicated. And that is the reason why your trades did not work. Let us look at USD CAD, for example. On USD CAD, the same thing applies. The same thing happened on USD CAD. This is the monthly equilibrium line. This is the weekly EQ. On the weekly EQ, as at the time of the analysis, this was our zone as at the time of the analysis. We all know that because on the D1, that is the bearish candle. That is the last bearish candle on the D1. We all know, you guys understand what I mean, right? As at the time of the analysis last week, this was our bearish candle. Now, you guys are waiting for price to come back into this bearish candle and then go down. Now, ask yourself, is this bearish candle on a higher time frame psychological supply level? It is not. It is not. The answer is it is not. It is not in a psychological supply level. And I like what Mammon did. Mammon did a very good job of identifying what market structure is. You can see market has been doing something like this in the past. For example, let's say, for example, this area has not happened yet. Let's say this area has not happened yet as at the time of the analysis. As at the time of the analysis, market has not happened yet as at the time. Now, as another flow trader, why are you taking a trade here? Why are you taking a trade around here? I don't see any reason why you should be taking a trade around there. Because it means that you are trying to take a trade in the middle of a rally-based drop formation of a higher time frame. You are trying to take a trade in the middle of a higher time frame rally-based drop. It doesn't make sense. It doesn't make sense. You are trying to take a sell trade in the middle of a rally-based drop, in the middle of a higher time frame rally-based drop. You can see this is a rally-based drop on a higher time frame. Rally, base, and a drop in price. And you are trying to take a sell trade here. Does it make sense to you at all? It doesn't make sense. It doesn't make sense. Why not sell around here? It makes sense if you sell around here than sell around here, than sell around here. So that is my point. That is the point. That is the point. And Mammon was able to identify this psychological level of how market structure play out on a higher time frame. So just because it is a higher time frame does not mean that the structure should be ignored. No, you shouldn't be ignoring the higher time frame structure. This is you remember I told you guys about internal and external structure. Let's say, for example, this is a general drop in price. This is a general rally in price, drop, rally, drop, rally, drop, rally, drop, and you expect markets to just rally a little and just drop. Is that the structure of the market generally? Is that the structure of the market? Ask yourself, is that the structure of the market? No, that is not the structure of the market generally. The structure of the market generally is that market was supposed to come down here, go back up into the origin of this area, go down, go up, go down, go up. That is what the market is going to do. So that is what we mean by understanding psychological level of the higher time frame. Understand what the market is playing out. Understand what the market is about to do on a higher time frame. Understand the market structure of the higher time frame. That is how to be a very good trader and a professional trader. So after understanding all these rules and regulations, and you also apply the psychological level, you also apply the D1 candle location, then you should be good to go. You should be good to go. All right, you should be good to go. Now, if it happens that you happen to follow all these rules and regulations, you happen to follow the higher time frame psychological location level, you happen to follow what we call the D1 candle location level, and you respected all the rules and regulations, you are taking a strong buy trade formation, you are taking a strong sell trade formation, and it still happened that you hit stop loss on a trade, then it is fine to hit stop loss on a trade after respecting the whole rules and regulation. It is fine. You cannot keep winning all the trades. You win some, you lose some. What is important is that you lose small money, you make bigger money, you make bigger amounts. That is what matters. If there's anybody who is telling you that there's a business and there is no small loss or there is no single loss in the business, then you need to run. You need to run, okay? You need to run. In any business, there's usually a risk involved. There's usually risk involved. But just make sure that the risk involved in any business you want to do, the business risk is very, very small. It is a very small risk you are trying to take. Okay, even big banks usually lose money in the market, but they rarely lose money in the market. You can see the irony here. It says that big banks usually lose money in the market. It is not that they don't lose money in the market, they lose, but they make sure that their losing is very small and their winning is a very big win. It is usually a very big win. All right. So if you happen to be a trader of Gova Trading Academy, following the pro course strategy, you follow all the rules and regulation, you happen to follow the D1 can do location level, the higher time frame psychological